the government borrowing did. We are now back to pre-budget level, 6.75. Jayesh, the rate now, Amandeep, in case you are not watching your screens, the bond yield is back to where it was before the budget, practically. So the ills of the large borrowing program has been done away with without the RBI extending any support except talking dovish at this point in time. But let me take issue with that, before I come to Amandeep again. Upasana, you can't have it both ways. You can't say that there will be borrowing program cancellations and CPI will be at 4.5. CPI will be at 4.5 provided government assumes this 10 rupees of oil price or 8 rupees of oil price hike, which the market has not been given, which the oil companies have assumed. November 4th was the last oil price hike when the crude was at 75. At least $10 of crude price hike has not been passed on to the market. Sooner or later it has been. If the government is going to absorb it, then we should give up any hope of the borrowing program getting cancelled. If they do pass it on, 4.5 inflation looks like a bit of a stretch. Upasana, your thoughts? I mean, can we have it both ways? Or is the RBI undercounting inflation?
No, absolutely, Lata. We are looking at an average of 50 basis higher than what RBI is saying, and especially in the second half of the year. So, the entire pass-through that we are talking about, that has been very understated probably by RBI's trajectory that we see. The bottom line is as of now, their trajectory suggests that they are moving towards 4%, their medium-term target of 4% in the second half of the year. That is very important because that is the tilt of the guidance that they are providing to the market at this point, that if over the medium term, within the next year, we are looking at 4% roadmap of inflation, then that talks volumes of what will be the expected rate hikes and the corrections that we're talking about in terms of policy normalization. So I think this is something very different from what we are envisaging going ahead. We are looking at inflation sustainably, or let's say in that range of 5% on an average, which still is going to be significantly higher than what the RBI's mandate is to move towards 4%. And you're absolutely right in terms of crude oil prices. I think there is a fair amount of understatement there, and we will see upside risks emanating. The pass-through we'll have to see even for next year. Let me just put it across. There is a much lower excise duty revenue which has been budgeted by the center. And my sense is there has been some kind of excise duty cuts which have been priced in as well. Otherwise, there is upside risk to the revenues there. So clearly, there is some kind of a pass-through which is expected, less pass-through, let's say, because of a possible excise duty cut that may happen next year as well.
Amandeep Chopra, the bond markets yields at 6.75%, they don't seem to be too perturbed by the fact that the reverse repo hike has not come. What do you make of the whole thing? Money market timings at least have been reversed. The windows for MSF and fixed rate repo. Signal of normalization perhaps, but do you think the entire 40 basis point hike could come in the next policy? Is that what the markets are working with?
I think the bond markets have really given their verdict on the fact that, it's been a status quo as far as rates are concerned. And more importantly, RBI continues to sort of retrade its accommodative stance with being accommodative as long as is necessary. So I guess these are sort of statements which continue to, give some comfort to the markets that there is going to be no abrupt change of the stance or any, sharp rise in any of the rates in the near term. So that's really what I suppose is driving, this sharp rally. You must also be aware of the fact that we believe RBI is concerned about, one-sided move in the benchmark rates. So you've seen, 2 steps being undertaken over the last few days, followed by, current dovish policy. My sense is that, while they have not announced anything in this policy statement in terms of how they will address the large, global borrowing in the next financial year, but as they've done in the past, they could come up with, certain announcements, whether it's HTM, which I believe is a low probability right now, but more in terms of, trying to indicate to the markets how they'll really support borrowings through, maybe intervention of UMOs. So I think that's really maybe some of the key takeaways here. Also look at the fact that I agree with some of the panelists here that this 4.5% inflation, outlook for next financial year is a very strong statement. It sort of indicates that RBI will be in no hurry to sort of follow what the currently markets are guiding towards, maybe a repo rate hike in April policy or even in June policy. I think RBI may choose to be a lot more slow as far as touching the rates concerned. So I guess this combination is going to be very helpful as far as the rally in the bond yields we've seen. On the liquidity front, you're right. This is nothing but a continuation of what RBI had announced in the last policy. They did reiterate the fact that going forward, especially from the 1st of January this year, the primary tool of liquidity management will be through variable rate reverse repos and variable rate repos. I think they've just made that as a primary tool. So during morning to sort of office hours, 9 to 5:30, they will choose to use different maturities of VRRRs and VRRs to manage liquidity, and you can access the fixed rate repo or the reverse repo window only after that. So I guess this only goes to indicate that you may continue to see a lot more active intervention as far as liquidity management is concerned.
Okay. All right. Now the monetary policy statement is in, and not a comma has been changed in the stance. Yeah. The MPC has decided to continue with the accommodative stance as long as necessary to revive and sustain growth on a durable basis and continue to mitigate the impact of COVID on the economy while ensuring that inflation remains within the target going forward. Okay, now let me get more thoughts from all of you. I just want to once again reiterate that all markets have given the governor and the MPC a 31-gun salute, as it were, except the currency market, which is a bit under the weather. The currency now pushing towards 74.92. So there you have seen about a 0.15% rise in the rupee or fall in rise in the dollar or fall in the rupee. But otherwise, in the bond market and in the equity markets, particularly in the finance stocks, I can't see a single red tick. Okay, there are a few which are mildly in the red, one of DCB Bank, but then that's responding to its results. And there's a South Indian Bank, etc. A couple of state-owned banks as well, PNB and Canara. But otherwise, it's a sea of green in the financial sector, and likewise in the non-banks as well. Largely, it's a sea of green. So clearly, markets celebrating, housing finance companies, I would assume even realty companies are extremely excited. But now, to come to the crucial point, do you think, Abik, the governor has missed, the RBI has kind of missed a very good opportunity to hike reverse repo? I mean, it's always going to sound a little like normalization. Right now, when there is no borrowing, when anyway the market is extremely sitting light and, the governor has even talked it down, would it not have been a sensible thing to do the reverse repo hike now? Would you want to do it at the time of the borrowing program beginning? Your thoughts, Abik?
Well, I think the RBI has sort of shown its hand over the last few policies. It's not going to do anything, marginally disruptive in terms of rate changes, unless they are convinced that recovery is on a firm footing. And they're sort of keeping on reiterating the fact that by sort of changing the liquidity absorption mix, they are effectively, so they're using the word effective reverse repo, the phrase effective reverse repo rate. Yes, I mean, if you look at it in terms of very conventional monetary policy, there is sort of a legitimate concern about whether the RBI is falling behind the curve. I don't think I would take that as a major issue, because I think everything has been done in terms of liquidity management, and through that they have achieved quite a bit, both in terms of pushing the anchor rate up at the short end and achieving significant changes in rates both at the short end and at the long end. Okay. So I was expecting this kind of very, very dovish status quo all along.
All right. No, to me, it just looked like probably you're letting a good chance go to normalize rates, to normalize the corridor, and at least remove volatility, because otherwise you're seeing the short-term rates all over the place on some days, especially when liquidity, moves wildly. Mr. Tiwari, last thoughts from you. Your bank has been guiding for what, 8.5%, almost 9% credit growth. Given such a dovish policy and the boost to growth coming from the budget, Do you think you all will even do the magical double digits? Do you think credit growth could actually do better than expected in the remaining months of the year?
So that would be good to have, but as of now, we still continue to stick to our stance of the 8 to 9% as guided by the chairman. We are seeing very good traction in the month of January and early February when draws have happened in the various working capital limits, and the unlevered limits have come down from 53 to 45 thereabouts. So therefore, we are already seeing this happen. New projects are also coming on now that the plans are made and people are now coming up with proposals and draws are happening. So therefore, this is a good thing, and we would like to continue on this stance at the moment. If more happens, fine, but we have only less than 2 months to go. So I think last minute draws, etc., if something like that happens, which I don't see happening in a big manner, I think 8 to 9, 9.5, that would be good enough for us.
Okay. Mr. Tiwari, this extension of on-tap liquidity to emergency health services, 50,000 crores and 15,000 for contact-intensive sectors, will there be any takers to borrow from RBI from these windows?
Not really. We haven't seen too much take up in this. We have come out with some schemes for the health sector, etc. We have given some dispensations there. So we have seen some pickup there, but not in terms of this special dispensation given by RBI. We haven't seen too much of pickup there.
Okay. Thank you very much, Mr. Tiwari, for being with us. Of course, we will have more requests for comments from you and your colleagues once the Reserve Bank Governor conducts his monetary press conference, where I guess we will get more nuanced statements. Let me get Aditya Narain of Edelweiss Securities also in, because he covers the market which is most jubilant at this point in time. It's a 0.75 percentage point, 0.73 up on the Sensex and Nifty, and the Bank Nifty up 1.3%. So we are closing in on 17,600. Aditya, your thoughts? Would you go for the financial stocks now?
Well, I think as a natural reaction, yes. I think that's what we've seen with the market. And it comes as some sort of a relief, because obviously there was this overhang of, rates going up or the policy direction tending to change. But that said, I think from a more medium term, I'd be a little cautious in terms of the overall commentary. I think the RBI seems much more concerned on growth than does the equity market, right? Whether it is the fact that there's been no shift either in stance or in the rates, and the voting has been the same as it was the last time. I think the fact that the GDP growth numbers that they've put out for the third and fourth quarters of next year, they seem very, very tepid, 4 to 4.5%. So my view is that the RBI is materially worried about growth and the lack of it, which is not something that the markets have been saying in terms of their current levels of valuations. So I think in some sense, as I said upfront, there is a level of comfort that the market will have, and that's the response that you're seeing. But from a more medium term, I think there is a little bit of an overhang in terms of at least what the regulator is indicating in his confidence in growth.
That's a very prescient observation, Aditya. You're extremely right that earlier in the year, when people were giving us projections for FY23, 8% figured in several numbers, even 8.3 figured in some numbers in terms of forecast. It has, of course, been brought down subsequently by many people because of the next wave coming in, January getting disrupted, and supply issues continuing. But right now, the market also is between 7.5 and 8. But I take your point that Q3 and Q4, the GDP growth is at 4.3 and 4.5, largely because the base also will impact. But this is a very important point that Aditya is pointing out. Upasana, we didn't get the economist's view on growth. Is it in sync, or do you think the RBI is pointing out to worries of growth?
Lata, we are at 8.1% at this point in time.
Okay.
So 7.8 is broadly, I would say, not very different from what we are saying. And we do see a possibility of a 7.8 to 8.1% range, if that's how it is. And I still think that suggests that the recovery is underway, not probably to the magnitude at which we would compare to a pre-pandemic trend, but it is happening. And to that extent, I think there's a limit to which RBI can decouple from the global financial tightness that we are looking at this point. They will have to act very soon. Probably, like you said in the beginning, they are awaiting some cues from the FOMC, because until now, RBI has really front-run the FOMC. From the September policy, we have seen tapering and then actually OMO sales happening to an extent. And now where we stand, if the overnight rates are still at 345 or so, clearly we are not there yet. We need to get the overnight rate closer to the repo rate. And that is where they will have to act. Now, whether they do this through a reverse repo hike or they do it through overnight VRRRs, we will have to see.
Okay, Mr. Rajiv Anand, a similar question to you. Do you think, what Lata asked earlier, has RBI missed the opportunity of using this time to hike the reverse repo rate at a time when central banks around the world are signaling that Bank of England has already hiked rates? The US Fed is expected to hike rates. How would you read into this? And actually, the broader question is, what can an ultra loose monetary policy achieve at this point of time when fiscal is already in an expansionary mode?
I think a couple of points there, Ritu. One is, I think clearly we don't have a inflation problem like the US at this point in time. Yes, we should certainly be worried about the global commodity cycle and the depreciating rupee and therefore imported inflation to that extent. But I think the point that you make is valid in an environment where we are looking to normalize, not tighten, normalize monetary policy. I think the market was well placed to be able to take at least a 25 basis points reverse repo hike. And in the context of the fact that anyway the operative rate now is the VRR, which is now at 3.99%, to have 3.35% on the other side, to my mind, I think as Lata mentioned, is creating unnecessarily volatility. There are some players that are not availing of the VRR for sort of various reasons. And is therefore creating volatility at the short end. So I think the market was well prepared for one and would have taken it in its stride.
Actually, there's one plus and one minus for the bond market, which we haven't yet put on the table. One plus is this raising the voluntary retention limit by foreigners. It's been raised by a full 1 lakh crore. And when foreigners were given this, you can invest more in various government securities and corporate bonds if you commit to keep the money for a longer period, I think 3 years. Now that they could only do 1 lakh crore, 1.5 lakh crore, now they can up to 2.5 lakh crore, the limit has been raised. The bond market could be counting on that as an extremely positive step. The negative is that there were some people who were expecting that RBI will reopen the fixed rate repo window, at least for, about 50,000 crore or 1 lakh crore, because very often you put your money in 15-day VRRR and suddenly some client is asking for money. So you can't borrow from the fixed rate repo window. They have allowed, tenor, the variable rate repos, VRRs, as the governor said, but fixed rate repo they have not opened at all. Maybe, of course, bond markets will ask for an arm and a leg, to get easy money, but that has not been granted. So, Amandeep, on that issue, do you think this foreigners being able to buy more if they commit to keep the money for long is a positive? And in any case, at 6.75, are you going to grab bonds? Will you ever get it at this level?
It's not a big event, really, Lata. If you look at the amount and the more recent participation, as the 1.5 trillion is fully exhausted. So it is only natural to increase the VRR limits, for the foreign investors. And the range of products that you can invest in is, commercial papers, treasury bills. So it's not necessarily geared only towards sovereign bonds. So 1 trillion rupees overall, I suppose, is not really big enough to move the needle. I think the markets will still continue to worry about the gross supply in the next financial year and how that is addressed. So I guess these are just, smaller measures. But the comfort, I guess, like you mentioned, is clearly in the fact that RBI is cognizant of, concerns in terms of both supply and the spike in these. So maybe they will keep intervening as and when required to ensure that you don't see too much volatility in the benchmarks.
Okay, since we're going to be hearing from the governor again in the press conference, Abhi Barua, quick word, what would you want to know more from the governor?
I would just sort of want to know what his justification for the downward revision in the inflation trajectory is. Number two, what specifically does this thing of durable, broad-based recovery? How is it how can it be measured? What will be the first sign of that? And in which case, we should sort of induce them to move to a neutral stance. And why have they decoupled? What is the sort of reason? Although he's spoken about this earlier, to decouple from global central banks. Although their inflation problem is much worse than ours, and that has been a standard answer. But I think these are the questions that I would like to ask, and how credible some of these forecasts are, particularly the inflation one, the growth one is concerned.
Okay, maybe we want everyone to give the answer to the similar question that Ritu asked Abik. What more do you want to know from the governor, Amandeep?
I expect him to actually make a few statements around, how they will handle the borrowing calculate going forward. It will be more of subjective but comforting statements rather than any specifics or any numbers.
Yeah, I doubt he will speak anything about a GSAP and whether he has space. Yeah. Jayesh, any question to the governor?
Not really, maybe only in April, as the borrowing in April. Just to add on the voluntary retention scheme, right? That would normally help the corporate bond and the high yield bond. See, the limits for GSEC is widely open even today. Okay. So it's mostly, where you can buy a single ISIN 100%. It's like, so that kind of thing. It will definitely help the high yield and the corporate bonds.
Okay, a small palliative because we don't have a bond index inclusion yet. Aditya, any questions?
Two. One, of course, on loan growth, just their sense of what it will be like, because it just stayed at this level for a very extended period of time. They put in all the monetary support and it's not played through as yet. So that would be one. And secondly, the risks that they foresee from decoupling the way they are doing from global central banks.
Oh yes.
Yeah, whether it is on the monetary side or on the growth side.
Absolutely.
But the risks that they may or may not be appreciating there.
Sure. Mr. Rajiv Anand, from a banking point of view, is there anything you want to hear from the governor?
I tend to agree with what Aditya mentioned. I think decoupling away from what's happening globally, obviously, as the rest of the world, particularly the US, is raising rates, we don't raise rates. Obviously, you're already seeing that today, that the rupee will take a hit. And I think understanding how RBI is thinking about that is critical. Absolutely. And the second is, I think the curve is steep, and I think in that context, you will tend to see markets and market participants, including corporates, utilizing this the short end of the curve to fund its balance sheet will be very good in the short run, but could potentially increase risks on balance sheets as we go forward, because I think it is inevitable that rates are going to go up. I mean, you can argue on whether rates are going to go up in the next 3 months, 6 months, or 1 year. Yeah. And so therefore, in a sense, you're creating a higher level of risk on balance sheets.
Your question is really, aren't you harming financial stability, especially since the governor has repeatedly made that the cornerstone of his policy. Upasana, last 10 seconds.
Yes, absolutely. I think it's linked to just what the other panelists said. Largely, more explicitly, I want to know whether this overnight rate that we're talking about, which is currently at 3.45%, is there any intention of very soon moving towards the repo rate, 4%? I mean, it's linked actually to financial stability and to decoupling. So more explicitly, do we move from an overnight rate where it is right now to closer to repo rate?
Got that.
Okay. I think in unison, the participants are worrying that the Reserve Bank is striking out a very diametrically opposite path compared to the global central banks. Even the otherwise dovish ECB has now started speaking about, how at the moment macro-prudential steps can be made more rigorous, and, how they have to remove the excesses of monetary policy. It was as direct as that, the ECB statement, and the Fed, of course, has made no secret of its desire to tighten. In such a context, the Reserve Bank talking so dovish, what are they, why are they striking such a diametrically opposite note? That would be one question. And the second question, of course, would be, this is a huge gamble on oil and inflation. What are their assumptions for a 4.5% inflation? I think that question is crying out to be asked. I'm sure the governor will proactively answer it. Upasana and gentlemen, thank you very much for being with us and making sense of the policy. The market has made a very positive sense. Aditya has put his finger on the growth issue, and maybe there's a little bit of profit taking, but at the moment they are enjoying the fact that the monetary policy has only good news for equity markets, for risk takers, and therefore, let's wait for the April policy to see if there will be anything more. Nothing for the bond borrowing program at this point in time, but why hurry? You can hasten slowly on that issue. All of you, thank you very much for being with us in this special monetary policy hour. We are handing the baton to stock markets and to trading hour, which will follow after a short break. But we will be back at 12 noon with the governor to take you through the press conference.